Hey guys, welcome back to BuyBlack. Today we are going to have an episode that's probably not going to get a lot of editing, and hopefully it'll be a bunch of good information for you. But I'm on the road, I'm traveling, and I'm up pretty late tonight trying to get this thing put together and knocked out for the series. But I got to be up early in the morning to go teach a class this week. So I'm going to put the information out here and may do a little bit of light editing just for the quality of the audio. But other than that, we're just going to have to roll with it because, life goes on. So this is the third episode in our series on starting your own business. And today's episode is going to be all about just understanding the differences between the different types of business entities. If you recall in the first episode, we had 5 critical things that you don't need to start your business and the 3 things you really do. Just quickly recap those 3 things. You need to have a problem, a real or a perceived problem that a market needs to have solved. You need to have come up with a solution to that problem, however simple or complex that solution is. And you need to have a market of people who are both willing and able to pay for your solution. So that's from the first episode. We followed that up last week by talking about a business model. Once you have identified that problem, and you've identified your solution to that problem, and you have a market that you want to target in order to get them to pay you for that solution, you want to make sure that you have a solid business model that you can apply, that's going to make you money, that you could put potentially in front of investors or in front of lenders if you want to get access to capital. Business model can be done on a single sheet of paper. We're not talking about a big complex business plan here that's 15 or 20 pages long and goes in depth. Those things they have their place, but talking about just starting a simple business, that's not where we're going here. Your business model is really just comprised of your value proposition, what you are offering to solve this problem for the market, who specifically within that market you're talking to, your customer segment, how you're delivering that value to your customer segment, be that delivery channels or distribution channels, as well as how you're maintaining relationships with that customer segment. And then on the other side of that, you have your key partnerships, your key activities and key resources, the people that you're working with or other companies that you're working with to create that value, the activities you're doing, and the resources you have to use. And then under all of that, you have your cost structure, what it costs you to have these partnerships, to do these activities, to access these resources. And then you have your revenue streams, how it is that you are getting your target market to pay you money for creating this value for them. That is all what goes inside of a business model. And we talked about, having those 2 things in line before we ever start talking about a business entity and which business entity to choose. So that's where we're going to go today, is talking about different business entities. So I got to give you a quick, of course, disclaimer. I am not a lawyer. This is not legal advice. So all that I'm giving you right now is just a breakdown of the differences between the main business entities that you're going to see in the United States and that you have to choose from if you decide to start your own business. The point of this information is just for educational purposes. A lot of people just don't know all this information. And so sure, you can go out on the internet and you can research it and read it yourself. And I'll have a couple of links in the description for this episode. However, part of the good thing about a podcast is you have somebody else do the research for you, toss you the basic bits of information. If you want to know more, you can go get that information for yourself. So that's what this show is going to be about. And I'm just going to jump right into it. So I'm going to cover 6 major types of business entity. I'm going to cover sole proprietorships, general partnerships versus limited partnerships, C corporations, S corporations, and limited liability companies. In these, I'm going to stick to some of the major differences. Specifically, we're going to talk about who owns the business, who manages the business, what your personal liability is as the owner of this business, as far as the business's responsibilities or the business's liabilities. We're going to talk about the taxation method, and then we're going to talk about how you get started. How easy or difficult is it to file the paperwork to get started on one of these businesses? So let's jump right into it, starting with a sole proprietorship. I talked last week or the week before last about sole proprietorship being kind of that's the standard, right? 73% of all the businesses in the United States operate as sole proprietorships. So that is the number one type of small business entity that you have. And with a sole proprietorship, that is just you, a single person who owns this business. The situation of management, same thing. You own it and you personally are managing your business on a day-to-day case. For personal liability, here's the drawback of a sole proprietorship. You are completely liable for all the obligations of the business, right? You have unlimited personal liability. What that means is that if you're operating a sole proprietorship and for some strange reason your business gets sued, right? For whatever reason, your business gets sued. Not only is the business and all of the business's assets on the table, but your personal assets, your home, your car, your bank accounts, everything that you own, you are liable for everything that is associated with that business if you run a sole proprietorship. Taxation method. This is taxed as what's called a pass-through, which basically means that your business does not get taxed separately. Whenever your company makes money, that money goes onto your personal tax return. So every dollar that comes into your company is going to be added to your personal tax return, and you're going to pay taxes on that money based on your personal tax rate, depending on what your income bracket is. Following that with how you get started. So starting a sole proprietorship is the simplest thing in the world. All you have to do is file one form, and it's called a DBA, doing business as. So, for example, if I wanted to run my business around this podcast as a sole proprietorship, I could go to the state of Nebraska and I could file a DBA, and I basically register a trade name for this business, and it cost me $100. Just go in. Here's the name that I want to do business as. Is anybody else doing business with that name? No, they're not. Okay, sweet. You are approved. You are now doing business as Gerald Jones's awesome podcast business, right? Whatever you want to call it. And that's it. That's all you need to get started. So it's the simplest to get started. It's the simplest to run when it comes to as far as managing your cash flow, because money comes in, you start making profits, you manage your books, and then whatever that profit is, that gets added to your personal taxes, and you are taxed basically as an individual for that business. But again, you don't have any protection when it comes to liability. Something goes wrong with the business gets sued, you are personally liable for everything, right? So let's move that from a sole proprietorship to a general partnership. Really, the only difference between a general partnership and a sole proprietorship is that there are more people involved. Sole proprietor is just you. General partnership is 2 or more people. There's an unlimited number of general partners who are allowed in a general partnership, but every single one of those people who is a part of that partnership is also personally liable for the obligations of that business. Same thing, your management is going to be usually the partners. The general partners are part of the business. They are also going to manage that business. Personal liability we talked about, and then the taxation method. So again, this is pass through. So if you have a business that has 5 partners and you all have equal shares to the business, then each of you is basically liable for being taxed for 20% of whatever the profit is for that business, right? So if I've got 5 partnership business, we made a profit of $10,000 this year. All right, well, each one of you is going to have $2,000 of additional personal income added to your annual taxes. So it's pretty clean cut, pretty straightforward. As far as filing requirements, this is slightly different. Instead of just doing business as, you actually have to file a general partnership agreement, and then there may be separate filings if your partnership does something like it buys or it holds real estate. But ultimately, it's just it's submitting an agreement to the state. Hey, we are partners in this business that does business as XYZ. So both of those are very, very simple. I'm going to leave limited partnerships and limited liability partnerships out of it because that's a little bit too complex for where I want to go. So instead, we're going to skip right over those. So the next thing that I want to talk about is going to be the different types of corporations, right? We have sole proprietorships, we have general partnerships, and then we want to talk about corporations. So there's 2 different types of corporations, primary types of corporations that you're going to see. One is called a C corporation, and the other is called an S corporation. So I'm going to talk real quick about those 2. The first thing is going to be the C corporation. This is the type of corporation that you typically think of when you think about a business. When you think about the New York Stock Exchange, think about huge companies like, McDonald's or Abercrombie and Fitch or, Walmart. Any major company that is actually traded on a stock exchange, a major company that actually offers shares of its company publicly for sale. That's going to be a C corporation. And there's a lot of complications that go into forming a C corporation. So let's go over those real quick. First thing, with a C corporation, who owns it? It's actually owned by shareholders who own stock in the business. And they're basically going to own either common stock or preferred stock. There are different classes of stock that you can have in a C corporation. And there's an unlimited number of shareholders that's allowed to own stock in a C corporation, which is why you basically have to be a C corporation in order for you to do what they call go public, which is to start offering shares of your stock to the general public. All right. So it's owned by the shareholders. It's managed, however, by a board of directors. So again, we were talking earlier, your sole proprietorship, your partnership, those are owned by the people who own the business. Or I'm sorry, those are managed by the people who own the business on a day-to-day basis. But with a C corporation, you have to have a board of directors, and they have overall management decision-making responsibility for that corporation. Your board of directors basically acts like the representatives for the shareholders. They are in place to help guide the company in a direction that is going to maximize the value of that company for the shareholders. So they have the long-term responsibility when it comes to management. However, you also have officers within a corporation, like a chief executive officer, chief financial officer, chief operations officer, and so on and so forth. And those folks are managing the day-to-day responsibilities of the business. They report to the board of directors, and your board of directors reports to the shareholders. So it's a very complex situation when it comes to a C corporation. So when it comes to personal liability, the owners of that C corporation, those shareholders, they are generally protected against personal liability for that company. So for example, if you own stock in, let's call it Google, right? And somehow the managers, the officers running that business at Google make some bad decisions and the company gets sued. You as a shareholder, your personal assets are not on the table. Just because you own stock in Google when they get sued doesn't mean that whoever's suing Google can come after your personal assets. Now, the money that you have invested in Google, absolutely, that may be forfeit. But your personal assets away from your investment in that corporation are completely protected, right? So there's personal liability there's personal liability protection for the owners when it comes to that situation. As far as taxation, C corporation taxation method is something that you've got to understand. C corporations get what's called double taxed, which means that C corporation is treated as if it's its own entity, as if it is a being in and of itself when it comes to federal taxes. That corporation is taxed on its profits as if it were a person. So a few years back when Mitt Romney got all this stuff thrown at him for saying that corporations are people too, technically he was right. C corporations, in the eyes of the government, are people, and they are taxed as people. Now, on top of that initial corporate tax, whenever that company makes a distribution of any of its profits to the shareholders, saying, hey, you guys own stock in the company, we had a really great year, we're going to toss some of this money we have in the coffers at you for being such great owners. Whenever they make those distributions, guess what? Those distributions to the shareholders also get taxed. So it's double taxed. It gets taxed on the front end because there was a profit in this entity of a corporation. And then if they make a distribution, that money gets taxed again. And so because of that, you can lose a lot of money in a C corporation simply to taxation, especially if you want to take money out and give it to the owners at any point along the line. Additionally, on top of that taxation method, it's really complicated to get a C corporation started. the filing requirements, remember, from a sole proprietorship was just got to file a DBA. With a C corporation, you have to form bylaws. You have to file articles of incorporation. You have to create a board of directors, and you have to file organizational board resolutions. You have to create stock because, again, these companies are owned by shareholders. And then whenever you actually sell that stock, you have to keep a stock ledger. You have to know exactly how many shares of stock you have out at any given time and the value that that stock has been sold at. So there is a lot of work that goes into both starting and managing a C corporation. And you'd hear all that and you might think, why in the world would somebody want to do it then? Well, if you're big enough, if you're bringing enough money in, and you actually want the opportunity at some point to go public with your company, then you're going to need to be a C corporation eventually. But you don't have to start out as one up front. So there's a lot of value that comes from being a C corporation once you're at a point where, you are bringing in millions of dollars. You are managing multiple different units and departments. You need to have an entire officer corps to manage all things at the executive level, from human resources to technology and security. When your business is that large and you have an ownership base that is that large, you need to have people in place to protect the interests of those owners. You need to have people in place to keep those officers in check, such as your board of directors. And so once you get to a certain level, absolutely, being a C corporation is almost mandatory in order for that business to be run efficiently. But when you're first starting out, this is probably not going to be the entity for you. So moving from a C corporation, I talked about an S corporation. Okay, there's a little bit of a difference with an S corporation, and this is a really popular tax designation. So when you form a corporation initially, it's going to automatically be a C corporation. However, you can go back and you can file with the IRS and with your state and say, hey, I'm a C corporation up front. I know it, but I want to select or elect to be taxed as an S corporation. I want to change my designation to S corporation. Now, here's some of the information about an S corporation. First of all, who owns it? An S corporation is only allowed to have up to 75 shareholders, and it's only allowed to have one class of stock. So it's still the shareholders, it's still stockholders in an S corporation, but instead of having unlimited numbers of shareholders, and instead of having preferred stock versus common stock, and we're not getting into all that stuff today, you can only have one class of stock, and you can only have up to 75 shareholders. And all of those shareholders have to be United States citizens, okay? Only up to 75 shareholders, and they all have to be United States citizens. Who manages it? You're still going to have a board of directors that is going to manage your S corporation. And they have that overall management responsibility for the long term and to protect the shareholders' interests. And then you still have your officers that are going to run the day-to-day responsibility. When it comes to personal liability, again, there's generally no personal liability for those shareholders when it comes to the obligations of the corporation. So far, we're not seeing a huge difference between C corporations and S corporations, except limited to 75 shareholders, only one class of stock. But here's where things are going to change: the taxation method. Where a C corporation is taxed separately, an S corporation is a pass-through in a way that is similar to a sole proprietorship or general partnership. So the S corporation's profits are not taxed because they're going to be taxed when they're passed along to the owners, to those shareholders. If you have a small business or a small number of shareholders in your business and it's going to be entirely United States owned and you want to be set up as a corporation, then there are absolutely benefits to setting up your IRS status as an S corporation when it comes to saving you money on your taxes each year. And when it comes to filing, how do you get started? Again, very, very similar to a C corporation. You have the articles of incorporation, your bylaws, your organizational board resolutions, stock certificates, stock ledger. The only additional thing is that you actually have to elect, you have to do an IRS and a state election form of S corporation, basically telling them, hey, we want to get taxed as this. Yes, we only have 75 or fewer shareholders. Yes, we are all United States citizens. Tax us as an S corporation. So there are a lot of benefits there for a small corporation or a corporation with few owners that are all United States citizens. So that's going to bring us to the last business form that we're going to talk about today. There are a lot more out there. We get into a lot of details about them. You got limited partnerships, limited liability partnerships, professional LLCs, professional corporations. There's all that. We're not getting into all of that stuff because if you get to the point where it matters whether you're going to file as a LLC or a professional LLC, you're probably going to have a lawyer involved. And you're definitely in a situation where you've got a professional license, like you're a doctor or you're an attorney or you're an accountant. That's a whole different set of rules. It's a whole different set of I want to say issues, but I guess what I'm looking for is concerns that you're going to have that you're going to want to take up with an attorney before you decide how you want to set up. We're just keeping it simple today. So the last one that I want to talk about is going to be an LLC, a limited liability company. Okay. When we look at a limited liability company, the people who own that company are called members. They're members of the LLC. And you can have an unlimited number of members allowed in an LLC. What's the value of having that LLC? Well, you have your owners in it, and typically your owners also manage it. However, in an LLC, you can hire a manager or designate one or two of the owners to be the managers of the business, even though you have other owners that are in the business. So you could either manage it yourself, you can manage it with the other members of the LLC, or you all can hire in someone to manage the day-to-day operations of the LLC. And that'll all be laid out in something that's called your operating agreement, which we'll talk about here in a little bit. All right, personal liability. Well, as you can see in the name, limited liability company, there's generally not going to be personal liability of the members for the obligations of the business. Now, there are limitations to that. Just like with any other situation with one of the corporations, if you are working within the business, if you have what's called a fiduciary responsibility to that business and to the owners of the business, which basically means that you are there to act in good faith and in the best interests of the owners of that business. And if you knowingly and willingly are making decisions that go against those best interests, that are causing harm to the company and to the shareholders, then absolutely your liability protection is going to be forfeit, because now you are actively working against the interests of the business or the owners of the business. And those people should have right to come personally after you for not holding up your fiduciary responsibilities. But in general, if everybody's acting in good faith, everybody's working in the best interests of the company and of the owners, then there's generally no personal liability for the members of that LLC for the obligations of the business. Now, another great thing about LLC, when it comes to taxation, it's pass-through. Pass-through, again, means, hey, we're not going to tax the LLC by itself. Whenever that LLC makes money, the members are going to see that additional income as taxable on their personal income tax statements. All right, so we've talked about who owns it, who manages it, personal liability and taxation, and then how you get started. This is one of the easiest ones to get started, almost as easy as filing a DBA for a sole proprietorship. The only documentation, at least I know in Nebraska, the only documentation that I have to file and that you typically have to file for an LLC is something called the Articles of Organization. In Nebraska, they call it a certificate of organization. It's very, very simple form. Costs just over $100 to submit one to the state. And then you also have an operating agreement. So that operating agreement basically lays out all the details about how that business is going to be run and who has ownership, how much capital they're putting into the company. All the details about who does what is in something called an operating agreement. And you keep that. As members of the LLC, you all sign it, and then that is the official document governing how you're going to agree to run that company. But those are the only two documents, and the only one that goes to the state is the Articles of Organization, or the Certificate of Organization. Now, I finished with LLC for a reason. One very cool thing about forming an LLC is that you get to elect as an LLC how you want to be taxed by the state and by the federal government. As a limited liability company, you are automatically taxed as either a sole proprietorship or a general partnership. That's the automatic designation, which means that all of your income is passed through. However, you can elect to be taxed as either a C corporation or as an S corporation, even if your company is an LLC. That's really cool. Why you would want to have your LLC taxed as a C corporation, I do not understand. I doubt many people do it. However, that S corporation designation, if you look at being an LLC and having all of your companies, let's just say you're a sole member LLC, which means you're one person and you've decided to create an LLC, right? This is my situation, right? If I'm taxed as a sole proprietorship, as a single person LLC, that means that every single dollar that my company makes is going to go onto my personal tax return as taxable income. Every dollar of profit, and I'll get taxed at my rate. Now, if I elect to change my tax designation to an S corporation, because I am an American citizen, I am the only shareholder, so it's less than 75, I qualify to set it up as an S corporation. Well, now that money is not taxed until it's distributed to me. So when I make distributions of those profits to myself as the owner, then those distributions are taxed as distributions, not as income, which means it's going to be a lower tax rate. Instead of my regular tax rate, I think distributions are taxed as if they're capital gains. So 15% as opposed to 28% or 35%, depending on how much money you're making every year, right? That's a huge tax savings. The only trick to that is that you can't just set yourself up as an S corp, work within your company, take no salary at all because now you're making your personal income zero, and then take all your money in distributions. Government frowns upon that. In fact, it's illegal. You can't do that. You have to pay yourself a reasonable wage. Basically, whatever the market rate might be for someone doing your job in your company, you have to pay yourself that salary. And the reason for that, well, when you're paying yourself a salary, now you have self-employment taxes, now you have SSI that you're paying, now that you have your Medicare, your Medicaid, all those FICA taxes that need to be paid and employment taxes that need to be paid, the government is getting their due. So if you're running your business, and typically the work that you are doing to run your business, if you were working in the public market, you'd be getting paid $40,000 a year. So you pay yourself a salary, $40,000 a year. You pay self-employment taxes on that personal income based on that $40,000 a year. And then let's just say that your company made a profit of $100,000. It's great. You decide to retain $60,000 of that profit, leave it inside the company, and you decide to distribute $40,000 of that profit to yourself. Well, that whole $100,000, as it's sitting inside your company, that's not getting taxed because it's a pass-through. When you distribute that $40,000 to yourself, that's going to get taxed at the capital gains rate, 15%. So now, instead of getting taxed on $100,000 of personal income, if you were set up as a sole proprietorship, you're getting taxed on $40,000 of salary as income taxes, and then you're getting taxed on $40,000 of distribution or capital gains taxes, which is at a lower rate. So you're saving money on taxes being set up as an LLC with an S Corp designation. So this is all a lot of information to take in, I'm sure. And I definitely recommend that you find a few blogs, you talk to a lawyer or two, and you think about the different types of business entity and which one might work best for you when you're running your business. I can tell you based on my personal experience. The first thing that I did, very first LLC that I set up the LLC. I immediately went to file it as a S corporation for taxation purposes because obviously that's going to save me the most money in taxes. Well, problem with that is it really doesn't work well when you're not making a lot of money with your LLC. All it's doing is adding a bunch of layers of complication Because how am I going to pay myself, let's just say, a $40,000 salary when my business isn't making $40,000? Is it even worth all the headache of trying to figure all those different things out between employment taxes and these kind of taxes and those kind of taxes and distributions of money that's not even there? There's no point in it. So if you're just now starting your company and you don't have a huge amount of income coming in, it ain't going to hurt you to be set up with your LLC and have a sole proprietorship taxation. Because whatever money comes in, let's just say your LLC brings in $15,000. Okay, great. You got an extra $15,000 just put on top of your personal taxes. Clean is simple. You pay the extra taxes. You're done with it. It keeps life clean. Now, let's say 2 years from now, your company's bringing in $300,000. Well, yeah, then you're probably in a situation where you want to look at getting set up as that S corporation, because now you've actually got income that you want to protect. You want to give the government their due, but the government ain't always do what it wants to take. So if you have the ability to take advantage of something like an S Corp designation, given the number of people who own in your company and that you're all U.S. citizens, then yeah, it would be to your advantage in a situation like that to pay yourself a reasonable salary, pay your employees their salaries, and then take out distributions for your from your company in your profits and then pay that lower tax rate. But that all has to do with having the money there to do it. So looking at all these different business entities, definitely do more of your research. But ultimately, this is my opinion only. If you're just getting started and you just want to get out the door, just go ahead and set yourself up with a DBA. Just file it. Hey, I'm doing business as this. And you just start doing business. When you start bringing in money, when you start actually going out into the market and providing a service or providing a product, you're going to start seeing what all of the issues are. You're going to start seeing where liabilities might come in, where there are risks, whether or not the type of business that you're running is one that, maybe I should form an LLC because there's a little bit of risk involved in this. And if this thing happens or if that thing happens, or let's say I hire on an employee and that person does something, I might get sued. I definitely don't want to lose my house and all of my assets if I get sued. So, maybe I should set this up as an LLC. You don't really know that until you're doing business. So rather than getting paralyzed and looking at, man, should I be an LLC? Should I be a corporation? Should I choose this tax versus that tax? Look, if it's just you, just go file a DBA and start doing business. Start doing something. Because as soon as you start moving, that's when you're going to start seeing the opportunities, the risks, and which path you should go down. If it's you and a friend, again, just form that partnership and just start working. Figure out whether or not a partnership is right before you go investing all this time and money into building all this structure around what you're doing. Do the simplest thing first. Get started. If you find out, hey, I'd rather do this alone, or this is not a good partner, then you're not that far into it. You can split the income that you made or the bills that you've created. You can wipe your hands of each other and you can move on without all this other complex stuff involved. Just stop letting all the questions keep you paralyzed. If you have a business idea, follow those steps that I've given you in the last couple of shows. Figure out those 3 things that you need. Set up a business model, and I'll be very happy to help you with that. If you want to reach out to me, email, as always, gjones@buyblackpodcast.com. But set up that business model and then just file your DBA, file your general partnership agreement, and get started with offering your solution to the market so that you can actually find out what your business is supposed to look at, because you will not know until you're doing something. And then you adjust from there. All right, so that's it for this show, guys. I know it's not my normal style, but like I said, it's pretty late at night. I got to be up at 6 o'clock in the morning to go teach this class, but I didn't want to leave you guys hanging because this is good, important information that I think we all would like to know more about. And I hope this is a good introduction to kind of lead you to doing your own research and figuring out which type of business entity might be right for you. Quick housekeeping things before I let you go. The number of downloads constantly going up. I really appreciate you guys. it's really exciting to wake up on a Monday morning or on a Thursday morning and check and see that, there's several people who, as soon as these episodes drop, you guys are downloading them and you're listening to them. I love the fact that you're out there. I would really love to get some feedback from you of what it is that's working, what you'd prefer to see, and what I can do to make this show answer the questions that you have and get you connected with the people that you want to get connected with. So please reach out to me at the email, on Facebook. Again, we've got the BuyBlack Podcast community group, and you can find it just by searching that. It's BuyBlack Podcast community, and absolutely request to join. I would love to have you there. You can also find me just at BuyBlack Podcast on Facebook, on Twitter, and on Instagram. Start reaching out so that we can connect. I definitely want to hear from you, and I'm looking forward to continuing to grow this audience with you. Last thing, the iTunes reviews, they really, really help. So far, we've got 3 reviews. We've been sitting on those 3 reviews since day one. And I really appreciate the 3 of you who went out there and dropped those as soon as the show dropped. But I need more of them, guys. I need you to take just a few minutes, hit up iTunes. If you don't use iTunes, if you use Stitcher, that works as well. But just go to one of those platforms, leave us a rating or review. It really does help with getting the show in front of additional people on the iTunes platform or the Stitcher platform when they go in to search. More reviews means more popularity, which means that their algorithms are going to throw our show a little bit higher up on the list than others. So really help me out with that. Other than that, guys, it's been fun so far. I'm ready to just keep it going. I'll get this thing cleaned up, do a little bit of editing. We'll get it out there for you this morning. And I can't wait to catch you on the next round on Thursday. We are going to finish up the series with 5 secrets that you need to know before you pay another company to go file your business paperwork for you. So all this business paperwork that we just talked about that you need to file, before you pay somebody else a bunch of money to get it done, we're going to talk about some things that you really need to know this coming Thursday. So definitely tune in, tell your friends. Thank you for listening to this episode, and I will see you next time around.